Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about United Community Banks, Inc. Annual Report. United Community Banks, Inc. offers a wide range of financial services to various sectors. At its core, the company provides deposit products such as checking, savings, money market, and other deposit accounts. These services cater to individual customers' needs for managing their finances. In addition to deposit products, United Community Bank also offers loans that cover various aspects of business and personal finance. This includes owner-occupied and income-producing commercial real estate, CRE loans, commercial and industrial loans, equipment financing, residential mortgage loans, home equity loans, manufactured housing loans, and consumer loans. The company also provides construction and land loans for both commercial and residential projects. Beyond traditional banking services, United Community Banks, Inc. offers private banking, investment management, and financial planning services to its clients. This includes estate and retirement planning as well as insurance products such as life insurance, long-term care insurance, and tax-deferred annuities. The company also provides trust services for managing fiduciary assets. Furthermore, United Community Banks, Inc. offers non-deposit investment products and payment processing services to its customers. These services include reinsurance on property insurance contracts and payment processing solutions tailored for commercial and small business clients. Overall, the company's diverse range of financial services makes it a comprehensive banking solution provider for various sectors including commercial, retail, government, education, energy, healthcare, and real estate. The stock price of United Community Banks, Inc. has increased by a modest 3.23% in the past year, underperforming both the U.S. banks industry and the broader U.S. market. However, despite this relatively low growth rate, the company has experienced several notable events that have contributed to its stock performance. One significant event was the strong fourth quarter 2025 earnings release, which saw net income of $86.5 million and pre-tax, pre-provision income of $126.3 million. The company's operating earnings per share grew by 13% year-over-year, while revenue increased by 11%. This positive news led to a surge in the stock price, reaching a new 52-week high. Additionally, United Community Bank has made significant investments in its presence in Winston-Salem, North Carolina, transforming a loan production office into a full-service branch. The company has also been recognized as one of Newsweek's America's Best Regional Banks for 2026, marking the third consecutive year it has received this honor. Furthermore, the company increased its dividend to an annualized rate of $1 per share in the third quarter of 2025, demonstrating its commitment to executing on its capital plan. While these developments are positive, they do not appear to have had a significant impact on the stock price over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various trends and patterns. On the one hand, companies that have experienced revenue growth attribute it to strategic decisions such as acquisitions, increased sales, geographic expansion, and product diversification. These moves enable businesses to tap into new markets, increase their customer base, and expand their offerings, ultimately leading to higher revenues. On the other hand, companies experiencing revenue decline often cite decreased sales, depreciation expense increases, and derivative financial instruments fair value decreases as primary drivers of this trend. Decreased sales can be a result of various factors such as market saturation, increased competition, or economic downturns. An increase in depreciation expense can indicate potential decrease in revenue, while a decrease in the fair value of derivative financial instruments can also signal a decline in revenue. In addition to these key drivers, other trends and patterns have emerged from the analysis. Companies that used interest rate swaps and caps to hedge against interest rate risk saw an increase in revenue. Forward sale agreements were mentioned as a way to mitigate risk and protect expected gains on residential mortgage loans held for sale. Cash flow hedges were also used to mitigate exposure to variability of future cash flows due to changes in interest rates. Tax-related trends have also been identified, with companies experiencing a decrease in revenue due to expiring net operating loss carryforwards, NOLs, and tax credits being mentioned as drivers of revenue growth or decline. Overall, the analysis highlights the importance of strategic decision-making, risk management, and effective financial planning in driving revenue growth or mitigating decline. Net income and profit margins. A year-over-year analysis, the company's net income experienced a significant increase from $187.544 million in 2023 to $252.397 million in 2024, representing a 38% growth. This trend continued into 2025, with a further 30% increase to $328.095 million. The substantial rise in net income can be attributed to various factors. Profit margins also underwent notable changes during this period. Return on common equity, ROCE, and return on tangible common equity, ROTCE, saw significant increases from 5.34% to 7.07% and from 10.63% to 13.34%, respectively. The net interest margin rose by 23 basis points to 3.52%. Additionally, non-interest income as a percentage of total revenue increased from 8.4% in 2023 to 14.5% in 2025. Regulatory changes played a crucial role in these shifts. The bank's change of primary federal regulator from FDIC to Federal Reserve in 2024 had a significant impact on its operations and financial performance. Furthermore, the use of interest rate swaps and caps to hedge against interest rate risk resulted in losses or gains recognized on derivatives, which affected net income. These factors collectively contributed to the changes observed in net income and profit margins over the two-year period. The company's financial performance indicates a consistent trend of generating positive operating cash flow. In 2025, the company recorded an operating cash inflow of $331,954, demonstrating its ability to generate sufficient funds from its core operations. Similarly, in 2024, the company achieved an operating cash inflow of $154,820, further solidifying its financial stability. This positive trend suggests that the company is effectively managing its resources and generating sufficient revenue to cover its operational expenses. As a result, it can invest in growth initiatives, pay off debts, or distribute dividends to shareholders without compromising its financial health. Overall, the company's ability to generate positive operating cash flow in both years is a testament to its financial resilience and stability. The company's debt level has undergone significant changes over the past year. Initially, the acquisition of $301 million in loans from ANB on May 1, 2025, increased the total loan portfolio to $1.29 billion as of December 31, 2025. However, this was partially offset by a decrease in federal funds purchased from $195 million to $85 million. Furthermore, long-term debt decreased from $254,152 in 2024 to $120,400 in 2025. In contrast, the interest expenses have shown a notable decline. According to the most consistent information, interest expenses decreased from $550,373,000 in 2024 to $473,832,000 in 2025. This reduction is attributed to lower interest rates on deposits and the redemption of long-term debt issuances. Overall, while the company's debt level has increased due to purchased loans, its interest expenses have significantly decreased over the past year. The company has made several strategic moves through acquisitions and divestitures in recent times. On the acquisition front, the company has purchased loans totaling $301 million from ANB on page 48. Additionally, it acquired PCD loans, which had significant credit deterioration, and equipment financing lease receivables through various purchases. Furthermore, the company also acquired bank management teams and board members through acquisitions of other banks. This move is expected to bring in new expertise and help improve the overall performance of the company. On the divestiture side, the company has sold manufactured housing loans, resulting in a loss on sale. It also sold FinTrust, including goodwill impairment, which further added to its losses. However, it did manage to gain from the sale of lease termination and received an FDIC special assessment, implying a payment related to the divestiture. In another move, the company sold participations, although the amount is not specified. These strategic moves are expected to have a significant impact on the company's overall performance and financials in the coming period. The company's financial activities have been transparent in their annual reports. One notable aspect is the payment of dividends to shareholders. This indicates a commitment to rewarding investors for their loyalty and trust in the company. In addition to dividend payments, the company has also engaged in share buybacks. This strategic move aims to boost shareholder value by reducing the number of outstanding shares on the market. By doing so, the company can increase earnings per share and create a more favorable investment environment for its stakeholders. Concerns about supply chain disruption are indeed present. One major concern is the inability to monitor the condition of collateral, which can lead to unforeseen risks. Furthermore, equipment and inventory obsolescence pose a significant threat, as outdated items can become worthless over time. Additionally, external factors such as declines in general economic conditions or other unforeseen events can cause cash flows to plummet, making it difficult for companies to service their debt. These potential disruptions highlight the importance of careful planning and management in supply chain operations. That concludes the financial summary for United Community Banks, Inc. Feel free to comment below, and I will be happy to answer them when possible.